All right, let's unpack this. In the lightning-fast, high-stakes world of tech, NVIDIA consistently commands our attention. Their latest earnings report for Q2 FY2026 just hit, and well, while the headlines often grab immediate reactions, the true revelations are always kind of nestled in the details. Today, we're taking you on a deep dive into NVIDIA's Q2 FY2026 earnings analysis, cutting through the noise to uncover those genuinely surprising takeaways and what they truly mean for the road ahead. We've pulled together the official earnings press release, integrated it with real-time market data, just to give you the clearest picture possible.
Yeah, and what's fascinating here is that to genuinely understand these results, we need to view them not just as, raw numbers, but within the larger context. Market expectations, NVIDIA's own strategic decisions. It all plays a part. We'll be connecting those dots for you, helping you grasp not just what happened this quarter, but really why it matters and what those implications are for anyone following this company.
Okay, let's get into it. Now for slide 1, the at-a-glance scorecard. Let's kick things off with a rapid snapshot of NVIDIA's headline performance this quarter. And the numbers are, well, they're undeniably impressive. Total revenue soared to $46,743 million. That's an exceptional 56% surge year over year. Just huge. Their GAAP net income, their core profit, hit $26,422 million, a stunning 59% increase. And GAAP diluted earnings per share, or EPS, came in at $1.08. That's a massive 61% jump compared to last year.
And, for a high-growth company like NVIDIA, one that uses a lot of stock-based compensation, it's how they get top talent, right? Understanding diluted EPS is particularly crucial. It gives you a more conservative, a more comprehensive picture of per-share profitability. It factors in potential future share dilution from things like employee stock options, restricted stock units, stuff like that. It gives you a truer sense of what each share is really earning.
Right. And when we stack these figures against Wall Street's expectations, NVIDIA delivered clear beats. Revenue of $46.74 billion surpassed the consensus estimate of $46.1 billion. And non-GAAP diluted EPS of $1.05 also exceeded the $1.01 estimate. So on the surface, those are stellar numbers, right? Absolutely fantastic. But here's where it gets really interesting. Despite these clear beats, these incredibly strong results, NVIDIA shares actually retreated more than 2% in after-hours trading. What's going on there? Is Wall Street just never satisfied?
It's a fascinating phenomenon, isn't it? If we connect this to the bigger picture, the market's reaction wasn't just about the numbers themselves. It was how they compared to exceptionally high expectations, really sky high. Initial analyst sentiment, they acknowledged the strong results, the powerful forward guidance, but they quickly fixated on the fact that the critical data center segment's revenue fell just short, just slightly below the most aggressive, the highest Wall Street forecasts. This really signals that NVIDIA is priced for absolute perfection, and any tiny deviation from that, even by a hair, can trigger a quick correction. You might also have noticed a subtle but significant detail in those numbers we mentioned. GAAP diluted EPS actually grew even faster at 61% than GAAP net income, which grew 59%. That's not always the case. What's the implication here? How does that happen?
Yeah, good catch. This is a textbook example, really, of how financial decisions can directly supercharge per-share metrics. It gives a tailwind to EPS growth that goes beyond just operational profitability. See, for EPS growth to exceed net income growth, the number of weighted average shares outstanding, that's the denominator in the EPS calculation, it has to decrease. And that's exactly what happened here. NVIDIA's diluted weighted average share count declined by over 300 million shares this quarter. That reduction was driven by a really aggressive share repurchase program. They spent a substantial $9.7 billion on buybacks in Q2 alone. So by reducing the number of shares, each remaining share effectively claims a larger slice of the company's earnings, and that boosts the per-share growth rate.
Okay, that makes sense. Let's dig deeper. Moving to slide 2, the engine of profitability. Now let's dive into the core of how NVIDIA truly makes its money, dissecting their margins and what those figures really tell us. For the quarter, NVIDIA reported a GAAP gross margin of 72.4% and non-GAAP of 72.7%. Now, these are incredibly strong figures, obviously, but they're actually down slightly from last year's 75.1% GAAP and 75.7% non-GAAP margins. At first glance, a decline in gross margin percentage might seem like a red flag, right? Raises concerns about pricing power or maybe cost control.
You'd think so, but it's actually framed as a strategic trade-off, not a weakness. And it's quite fascinating when you look into it. While the percentage margin might be slightly lower, NVIDIA is capturing dramatically more total gross profit dollars. That's the key. And they're more deeply embedding their technology within their customers' operations. Management commentary confirmed this. They explained that the year-over-year decrease happened because their new Blackwell architecture revenue now primarily consists of full-scale data center systems. These integrated systems include some lower margin components, things like the chassis, power supplies, compared to just selling their Hopper HGX systems last year. So they're selling the entire solution now. This strategy significantly increases their total revenue and, more importantly, the total gross profit dollars they capture from each customer. They're taking a larger portion of the total system cost. And we also saw a strong sequential recovery from Q1 FY2026's 60.5% JAP margin. Remember, that was impacted by a one-time $4.5 billion charge for excess H20 chip inventory, that specific variant developed for certain markets.
Right, that H20 charge,
Yeah.
okay? And their operating income remains incredibly robust. GAAP operating income hit $28,440 million. That translates to a substantial 60.8% margin. And non-GAAP was even higher, $30,165 million for a 64.5% margin. That sounds like a highly efficient machine.
It absolutely is. I mean, this is a textbook example of positive operating leverage in action. While GAAP operating expenses grew, yes, a significant 38% year over year, revenue grew much faster at 56%. And as a direct result, operating income grew even more rapidly by 53% year over year. What this signals is that NVIDIA's revenues are scaling at a pace that just outstrips the growth of its fixed and semi-fixed costs. It makes each incremental dollar of revenue progressively more profitable. It truly demonstrates the powerful scalability of their underlying business model. They've hit this economic sweet spot where every new dollar of revenue is disproportionately more profitable. I mean, many companies dream of this kind of scalability.
Yeah, definitely. Now, for many of us listening, navigating the difference between GAAP and non-GAAP can sometimes feel like trying to decipher a different language on an earnings call. Can you break that down simply?
It definitely can seem that way, and it's an important distinction to grasp. So, GAAP, generally accepted accounting principles. That's the official audited accounting standard, set in stone, basically. Non-GAAP, on the other hand, adjusts for certain non-cash or one-time items that management believes might obscure the company's core ongoing operational performance. For NVIDIA this quarter, the primary adjustments when moving from GAAP operating income to non-GAAP included excluding $1.6 billion in stock-based compensation and also about $86 million in acquisition-related and other costs. You can think of non-GAAP as viewing, say, a car's engine performance without factoring in non-operational noise, like depreciation or maybe a one-time repair cost. So while it's useful for understanding core trends in management's perspective, always remember GAAP results are the official legally reported standard. And expenses like stock-based compensation are very real costs of doing business, even if they're non-cash sometimes.
That's a great analogy. Okay, let's move on. Now for slide 3. The engine room business segment performance. Let's peel back another layer and look at where all this impressive revenue is actually coming from. It's truly fascinating to see how the different parts of NVIDIA's business are performing. And when we talk about NVIDIA's engine room, the data center segment is clearly where the magic is happening. I mean, clearly. This segment is the absolute powerhouse. It brought in a colossal $41.1 billion this quarter. That accounts for nearly 88% of total revenue with staggering 56% year-over-year growth. What's fueling that incredible acceleration?
Yeah, it's just phenomenal. Management directly attributed this immense growth to the sustained, almost insatiable demand for their accelerated computing platforms. These platforms are absolutely essential for advanced AI applications, large language models, generative AI deployment. It's across industries.
All right.
The successful ramp of their new Blackwell architecture was a key highlight, showing strong 17% sequential growth. And cloud service providers continue to be a massive driver, representing about 50%, roughly half of the segment's revenue. And remember that stock dip we talked about earlier. Despite this massive $41.1 billion number, it was the fact that it came in just slightly below the highest Wall Street estimate. Some were looking for $41.2 billion that caused that negative reaction. It just shows the extremely high bar they're constantly measured against.
Right, the perfection expectation.
Yeah.
Now, here's where it connects back to our earlier discussion about strategy, I think. Networking revenue within the data center segment grew an explosive 98% year over year to $7.3 billion. This isn't just incremental growth. This is nearly doubling. What's the key takeaway from that specific detail? It seems huge.
It is huge. And yes, this is direct, tangible evidence of that strategic shift we discussed earlier, where NVIDIA is successfully transitioning from primarily selling individual components like GPUs to offering complete, integrated, full-scale data center systems. The robust growth in networking components, things like their InfiniBand and Ethernet solutions, is absolutely critical for these integrated systems. It essentially proves they're successfully selling the whole package needed to build and operate these AI factories.
Makes sense. Okay, moving on to their other segments. Gaming, which is their foundational business, still showed really strong results. $4.3 billion, up an impressive 49% year over year.
Yep, still a core strength. This growth in gaming was driven by strong sales and, importantly, increased supply of their Blackwell-based products. It indicates that their latest technology is being successfully adopted in the consumer market, too. It's a solid secondary growth driver, showing the continued strength of their core GPU business beyond just the AI data center craze.
And professional visualization contributed $601 million. That was up 32% year over year.
Yeah, this segment saw robust growth as well, primarily powered by the integration of Blackwell products into notebook workstations. These are tailored for really demanding workflows, AI development, real-time graphics rendering, complex data simulation. It showcases their reach into those high-end creative and technical fields.
And automotive came in at $586 million. Interestingly, that showed the highest relative growth rate among the major segments at 69% year over year.
That's right. This strong performance was driven by the adoption of their self-driving platforms D-Drive, Orin, and Thor by automakers globally. It really showcases NVIDIA's expanding footprint and, frankly, critical role in the rapidly evolving transportation industry. Big potential there long term. And even their smaller segments are seeing significant momentum. OEM and other, for example, grew a remarkable 97% to $173 million. It just shows diverse, albeit smaller, revenue streams rounding out their portfolio.
Okay, a lot going on across the board then. Let's shift gears, moving to slide 4. Financial strength and shareholder rewards. Beyond the sales and profits, let's look under the hood at NVIDIA's financial health and how they're rewarding their shareholders. This gives us a crucial sense of their long-term stability and confidence. They ended the quarter with a massive $56.8 billion in cash equivalents, and marketable securities. I mean, that's a huge war chest.
It really is. And what's fascinating here, connecting back to their outlook, is how they frame certain balance sheet items. While increases in inventory, which reached $15 billion, and accounts receivable might typically be seen as potential red flags for some companies, management explicitly framed them as positive leading indicators. The inventory buildup is strategically to support the ramp of Blackwell Ultra, their next-gen platform, and the rise in receivables is directly due to the timing of this new product ramp occurring late in the quarter. Furthermore, total purchase commitments, that's a forward-looking indicator of future spending, mostly with suppliers like TSMC, rose to a staggering $45.8 billion. So these are not signs of inefficiency, management argues, but rather tangible proof of the company actively preparing for an unprecedented surge in demand. It lends significant credibility to their exceptionally strong Q3 forecast.
That context is really important. And NVIDIA's business model continues to be a prodigious generator of cash. $15.4 billion in cash flow from operating activities, leading to $13.45 billion in free cash flow. So for you, as someone looking at this company, maybe an investor, what's the significance of that robust free cash flow? Why does it matter so much?
Well, free cash flow is essentially the discretionary cash a company has left after funding its operations and essential investments like capital expenditures. It's the critical resource that can be deployed for strategic initiatives, whether that's R&D, acquisitions, paying down debt, or, as NVIDIA has aggressively demonstrated, returning value directly to shareholders. It signifies immense financial flexibility and strength. It's what fuels future growth and shareholder returns.
And they certainly did return value to shareholders this quarter. A strong commitment, returning a total of $10.0 billion through buybacks and dividends. That includes the $9.7 billion in buybacks we mentioned, and $244 million in dividends. Remember our EPS supercharger from slide 1. This is the direct engine behind it.
Absolutely. And if we connect this to the bigger picture, the most significant announcement on this front was the board's approval, an additional $60.0 billion for its share repurchase authorization. This isn't just a routine renewal. The sheer scale of this authorization sends a powerful strategic signal to the market. It's huge. It communicates profound confidence in their long-term growth trajectory, and it strongly suggests that management believes the stock remains an attractive investment, even at these current, pretty high valuations. This provides a strong pillar of support for the stock price and virtually guarantees future EPS accretion. It gives investors a clear financial tailwind separate from just the operational growth.
$60 billion. That is a statement. Okay, let's wrap things up. Moving to slide 5, the road ahead management's outlook and key takeaways. Finally, let's look at where NVIDIA is heading and pull together the most critical takeaways from this entire deep dive. What should you really remember from all of this? Well, first, NVIDIA provided very strong guidance for the upcoming third quarter of fiscal 2026. They're expecting revenue to be $54.0 billion, plus or minus 2%. That is significantly above the $52.2 billion consensus estimate Wall Street had. Non-GAAP gross margins are also projected to improve sequentially to 73.5%. 5%, moving them closer towards that mid 70% goal they've talked about. And non-GAAP operating expenses are expected around $4.2 billion. I mean, that guidance alone is another blockbuster. So let's crystallize the takeaways. First, and this seems critical after that stock reaction, the market demands perfection. Despite beating revenue and EPS estimates, despite providing blockbuster guidance for the next quarter, the stock still retreated initially. This clearly signals that NVIDIA is priced for absolute perfection, highlighting significant volatility risk for investors.
Any perceived deviation from a flawless growth narrative, no matter how minor, can trigger a swift sell-off.
Exactly. Second key takeaway. The Blackwell transition is a strategic margin investment. That observed year-over-year decline in the gross margin percentage shouldn't be viewed as a negative sign or weakness. Instead, view it as a deliberate long-term strategic move by NVIDIA. They're aiming to capture more absolute profit dollars by selling these higher-value full system solutions. This allows them to build a more integrated and ultimately more defensible technology platform in the long run. It's about total profit, not just percentage. Third, the buyback is a powerful second engine for EPS growth. Don't underestimate this. Beyond its extraordinary operational performance, NVIDIA is aggressively deploying its monumental cash flow to repurchase its own stock. That new $60 billion authorization ensures this powerful financial tailwind will continue to boost per-share earnings growth, making their exceptional operational growth even more impactful for shareholders on a per-share basis.
And fourth, tying back to the balance sheet points. The balance sheet confirms the bullish outlook. The notable buildup in inventory, accounts receivables, and especially those massive purchase commitments isn't a risk factor, according to management. Instead, it's tangible proof of the company's proactive preparation for its next massive wave of growth, fueled by Blackwell. These financial movements strongly corroborate that exceptionally strong Q3 forecast.
Ultimately, NVIDIA's Q2 performance, it shouldn't be viewed as just a simple beat or miss in isolation. It's really a crucial chapter in its ongoing evolution. They are transforming from, primarily a chip company to becoming the foundational architect of the entire AI era. That's the big picture. This quarter's story is one of operational excellence, consistently meeting an extraordinarily high bar set by the market. NVIDIA isn't just participating in the artificial intelligence revolution, it is actively building its core infrastructure. And this quarter's performance solidly reinforces that central, indispensable role.
Yeah, and this is exactly why a deep dive using a consistent framework like ours hopefully helps you move beyond just the headlines. To truly understand the underlying drivers, assess the financial health, grasp management's forward-looking outlook, all of that. It's a repeatable method, really, for building a deeper and more informed understanding of your investments over time.
And maybe a final thought to leave you with. Given NVIDIA's strategic shift to these full system solutions and its super aggressive capital return program, the deeper question for investors now is whether the market's perfection expectation will actually adapt to this evolving business model. Or, if volatility will just remain a constant companion, even for the most successful AI architects like NVIDIA. Something to think about. Please remember, this report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. This report was generated by an artificial intelligence model. While designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.